All right, let's talk about one of the most powerful concepts in trading. But forget all the complicated charts and jargon for a minute. Instead, we're going to do this with a story about a very, very greedy elephant. You know that feeling, right? You're sitting there, watching the charts, carefully planning your move, and then bam, the market just rips against you. It feels like some invisible giant is pulling the strings, doesn't it? Well, that giant, that's our elephant. You see, on one side, there's you, the retail trader, the mouse, just trying to get your one little cookie. And then there's them, the smart money, the big institutions. These guys, their wallet isn't just bigger, it's basically bottomless. You're following the price, hoping to catch a move. They are the move. They literally set the price. And understanding this massive power difference, that's everything. But being an elephant isn't all easy. It comes with its own huge problem. Imagine you want to buy every single cookie in the entire store. If you just storm in and start grabbing everything off the shelves, what happens? The owner sees you, the price goes through the roof, and you've shot yourself in the foot. So our elephant needs a trick, a clever way to scoop up everything they want without anyone noticing. And that trick, it all starts with one simple move. Think about it. To get the highest jump possible, what do you have to do first? You gotta squat. And that, right there, is what we call a bullish order block. It's that last, sneaky little pushdown, that final red candle you see, that happens right before the price goes absolutely vertical. It's the elephant squat. So it happens in two parts. First, the squat. The elephant literally shoves the price down. Why? To scare you. To make all the little guys panic sell so they can buy up everything cheap. And then, once their bags are full, comes part two, the jump. The price just explodes upwards. And you have to remember the psychology behind this. It's so important. That push down, that's not the market getting weak. Oh no, it's a trap. It's a calculated move. The elephant is basically engineering a fire sale, scaring you into selling your stuff at a discount so they can buy it all. Okay, so we see a squat and a jump. But how do we know it's a real elephant move and not just, random market noise? We need proof. We need what I call the cannonball splash proof. This is maybe the most important question you can ask. Seriously, anyone can see a red candle followed by a green one, but telling the difference between a true institutional footprint and just static, that's the whole game. The answer comes down to one word, and you've got to burn this into your brain: displacement. This isn't just the price moving up. This is a violent, energetic explosion. It's the sign that the elephant is done accumulating and is now throwing its full, massive weight behind the move. Think of it like this. A weak move, that's like tossing a pebble into a pool. A tiny splash, a few ripples, who cares? But displacement? Displacement is our elephant doing a full-on running start cannonball into that pool. It's a huge, powerful, energetic move that shoves all the water out. There's no mistaking the power and intention behind that. And this leads us to our number one non-negotiable rule. No splash, no order block. Simple as that. If you don't see that incredible power, that obvious displacement, it's not a real setup. It's just a big candle taking a nap. You just move on. Okay, so we've spotted the squat. We've conferred the cannonball splash. You might be thinking, great, but I missed the move. Ah, but did you? Nope, because the best part is still to come. I call it the forgot my lunch move. So here's the playbook. First, you get the jump. The price rocket takes off. But a lot of the time, that move happens so fast that the elephant couldn't get all of its orders filled. So what happens next? The return. The rocket actually flies back down to the launch pad, back to that original order block. And that is where we're waiting for the bounce. Now, when the price comes back, there's one specific level you have to watch like a hawk. It's the middle of that first red candle. Some people call it the mean threshold. The easiest way to think about it is this. The whole order block is like a trampoline. As long as the price lands on it and bounces, we're golden. But if it crashes right through the middle, well, the trampoline's broken. The whole idea is off the table. And this is where patience really, really pays off. See, amateurs chase that first big, flashy move. But the pro knows the elephant's game. You wait. You calmly wait for the price to come back to you, to come test that trampoline. That return trip, that's your golden ticket. That's your high probability entry. So let's pull all these pieces together. The goal here isn't to try and fight the elephant. You'll get crushed every single time. The goal is to learn how to spot its tracks,
and then just walk right alongside it.
If you remember just one thing from all of this, let it be this. Don't chase the rocket. Chasing price when it's already moving at lightning speed, that's a mouse's game, and it's how you get trapped. A smart trader, one who gets how the elephant operates, waits. You wait for the price to come back to a place that makes sense. So here's your new playbook, the mouse's new strategy. It's just 4 simple steps. Step 1, spot the elephant squat, that last down candle. Step 2, confirm the cannonball splash. You need to see that powerful displacement. Step 3, and this is the most important one, wait for the return for lunch when the price comes back to the block. And finally, step 4, get on board and ride the elephant's wave. So there you have it. You've seen the trick, you know the setup, you know what to look for, and you know where to get in. You've literally gone from being the mouse that gets stepped on to the smart mouse who knows how to hitch a ride on the elephant. So the only question left is, now that you know the elephant's secret, how are you going to use it?